So our next presenter is Troy Armstrong, who is a financial advisor with Collins Co Wealth Management. His core business is the provision and implementation of strategic advice to deliver sound financial outcomes, providing specialist advice in areas of superannuation and retirement planning, wealth creation and protection. So if you'd all like to welcome Troy to the stage, that'd be great.
Thanks, Paul. Good morning, everyone. I know we're close to a caffeine top-up, so I'll try and keep everyone a little bit invigorated and get through this. So like Paul said, my name's Troy. I'm from Collins Co Wealth Management, and we're going to touch briefly today on reasons why, all that money that you've got sitting in the bank, you need to look at, investing that, ways that you can invest it, and how we can help here at Collins Co Wealth Management. Disclaimer, very much like Derek's presentation, don't take anything we say today as advice. We don't know your circumstances, so it is all general information. So presenting today, obviously myself, and we'll have Chris Willaton, our Head of Investments, who will also speak the second half of this presentation, just touching on what we invest in, how we invest, and how we can help out. Like I've already touched on, we'll talk about why non-for-profits, organisations, charitable foundations need to look at investing, how you make the right decision, and the steps, I guess, that are involved in finding the professionals to help you out, and then what we do in the whole process, how we can help you guys, and then we'll have some question time at the end. I'll leave it all for when Chris is here, so I can dodge some bullets. So trustee responsibilities. A lot of you guys will already know this, so it's not going to be new information. But why would trustees look at investing? You want to look at protecting, preserving and investing the trust assets to make sure that you've got some income inside the organisation. I know obviously there'll be things, particularly you guys, like memberships and donations that you receive, but what you've got there, you need to use that to generate some income, some capital growth, but it's also got to be protected. You don't want to be, talking to some bloke down the road who's over the barbecue that says put it in this really small company or something like that, and then you're in a bit of strife. Obviously, trustee responsibilities are there to manage the foundation. You've got to be careful, like we just touched on as well. You need to be safe with the foundation's assets or your organisation's assets, because you can't just throw it against the wall. And then obviously you want to ensure that the organisation's got a bit of longevity, it's sustainable. We don't want to be talking about insolvent companies and liquidators coming in like Derek did before. And obviously you want your organisation to be successful. Now this will apply to some of you as well, that it's something you've done already. You'll have an investment policy statement that is part of your organisation. This sets out, if some of you have done a self-managed super fund before, it's almost like an investment strategy for your organisation. It just sets out bits and pieces like how much risk you're willing to take, and to be board members and all trustees that help decide these things. So you're looking at how much risk you're willing to take if we are going to invest at all, who's going to do the investing, what professionals you're going to utilise. And these are all things that we can help with, put together into this statement, and make sure we're not breaking any rules as part of the Constitution or any governance rules that you already have set up. Now, why invest? You want to maximise the funds that you have. I've never really had anyone in the non-for-profit organisation come up to me and say, we've got too much money. So you need to maximise what you've got. Every little bit counts, especially when, funds could be drying up through donations or whichever. And then touching on donations, and you'll see in the next couple of slides that they're starting to dry up a little bit. They're on a little bit of a decline. So once again, you just got to make the most of what you've already got. And the current climate. So the current economic climate, that is, not the weather. You'd all be aware that your typical low-risk investments that we've all used and we all always have are just not as profitable as they used to be. Fantastic if you've got a mortgage, but if you've got some money in the bank, it's not great. So for you guys that do rely on donations, this is just a little slide just to show there that, you know, we are, as Australians, donations are starting to decline. The number of people donating to organisations are starting to decline. Now, I've got these numbers from a QUT study that is on who actually ticks the box on their tax return and says, yes, I made a donation. So, look, some people might not tick the box, but over the last few years, you can see that the number of individuals are starting to decrease who are donating to foundations and charitable organisations. So, once again, you need to make every dollar you've got, you know, work that little bit harder. This is an interesting one that shows, you know, we think we're a bunch of nice people here in Australia, pretty charitable, but you'll see there that Australians that do donate put in about 0.3% of what we earn. Now, we compare that to the States, who's very close to 2%. It just shows that we as individuals don't tip in a lot to our organisations and our charities. And once again, just goes back to you just got to make the most of what you've got at the moment. The current climate, so current economic climate. As you'll see here on both sides, so the slide on the left there talks about the current cash rates. We hear it every month. The RBA has a meeting and they go, yes, we're going to not do anything, which was for a while, or no, we'll give it a shake up and we'll cut the cash rate again. So as we can see, cash rates are down. You'd all be aware of that, but this is your typical safe. There's no safer asset in this country than cash, but it's just not giving the return that it used to. Like I said, you've got a mortgage, fantastic, but cash now, down under 3%, now it's in about 2%. That blue line underneath actually takes inflation into account. So if we put inflation and marry that in with what the cash rate is, we're actually not earning anything at the moment on cash. So obviously inflation, prices of goods go up. So inflation is basically breaking even with the cash rate. You've got your funds, the charities funds, the organisations funds in cash. Unfortunately, it's not going anywhere. Another safe investment vehicle that that organisations do use, once again, it's on the very low end of the risk scale. You can see that they've been in a decline for the last 3 or 4 years. We've just had a little jump up, you know, recently, but once again, we're just not getting enough from those low-risk investments that if we wind back 5 years, we got 7% from. So those days are gone, are probably a long way away. So we need to look outside the banks, look outside your cash accounts, and look at other ways to try and generate some income or some growth with your assets. Making the right decision. Like I said, unless you're an investment advisor yourself, you will need professionals around you. And it's not just on the investment side. We talked about the accountants, you know, solicitors. You need professionals around you to help you make the right decisions, smart decisions, safe decisions, to make sure you're not putting, the organisation's assets at risk. Obviously, they've got to be highly skilled. At Collins Co Wealth Management, we've got some fantastic investment managers. I'm not an investment manager, I'm not as smart as Chris. But we've got a really good team there. Obviously, the accounting groups that we've worked with as well, with obviously Collins Co and the guys there are fantastic. But you've got to make sure that they've got the experience and they're qualified. You don't just, want to give it to someone that got their qualification off the back of a Weet-Bix box. We'll work with you, whether it's daily, weekly, monthly, whichever, to make sure that we're helping you achieve your goals. We're not going, to shove goals down your throat and say this is what you need to achieve. You let us know, we work with you, and that's how we come to the outcome. We don't, like I was saying before, we will assess how much risk you're willing to take, but we'll liaise throughout the whole time. If the board of directors or the board members or the trustees want a monthly update on what's going on or what we can do to help, that's not an issue. It's not a closed door, and we'll work together day in, day out if need be to make sure everyone's comfortable and happy with where it's all going. So the initial steps. So let's fast forward a little bit, pretend that you've loved everything today and you want to sit down with us and you want to bring the trustees along. We will sit down basically and go through a meeting initially that won't talk anything about asset selection, how much you're going to earn, anything like that. It'll just be going through, go through your investment policy or help you rewrite an investment policy. Obviously, we want to really know what your organisation's goals are. That's critical. How much risk you're willing to take on an investment point of view. Once again, Chris will touch on it as well. We don't choose how much risk you want to take. It's up to you. It's directed by the trustees or the board or whoever. But we'll help you grow your organisation in line with your goals and something that you're comfortable with. As mentioned before, we can provide reporting to whomever needs it. Once again, board trustees, we've got the tools there to provide very in-depth reporting, and it can happen as often as you like. We will partner as well. You may have existing partners, so other professionals that you work with. They can be included on the process, or if there isn't, if there is, I guess, an accountant or solicitors or someone that you need to team up with and we need in there as well, we'll use our networks to help out. But if you've got existing professional relationships, we're happy to have them, part of the process as well. But in a nutshell, you direct us a little bit in the way you want to go, and we'll make sure that we help you maximise that to the best of your ability, or best of our ability. Now, I will hand over to our Head of Investments, Chris Willaton now. He'll talk a little bit about the asset selection, the risk profiles that we do put in place, and it'll just put a little bit more substance around, what we do and how we do it.
Thanks, Troy. I had a technology presentation to give the other night and I couldn't work how to use the pointer, so it wasn't a great example of technology, really. Now, Troy, before you go away, is it the green one? Yeah, that's it. Excellent. Very good. All right. Thanks, everyone, for coming along today. It's a wonderful turnout, so it's obviously it's great to have you all here, and we hope you get a lot out of the day's proceedings. Asset selection. Does anyone here have any shares? Anybody? There's a few. Yep. Have you ever lost any money on shares? A couple of hands. Not a lot of honest people here. Okay. Very good. Asset selection is critical for many, many reasons. And not the least of which is because you're always going to lose some money at some point. So it's critical that we get the right balance and we pick the right assets, and more importantly, that we work through the right rationale to arrive at that decision. The reality is there's a million different ways you can invest, and a lot of them work. A lot of them work well. It's just important to get the right one for you. Risk management. Risk management means many different things to many different people. I know a lot of old ladies who might be sitting on Commonwealth Bank, ANZ and Westpac shares, and they think that's a low risk investment. That's where they've got all their money. So get my dividends, the banks are always going to be there. It's not necessarily the case, because bank shares can go up and down in value, and a lot of it's about timing of when you need the liquidity, not just from the income, but also you might need to free up larger chunks of that asset. So having all your money in just bank shares isn't necessarily a prudent risk management strategy. So it's all about getting the right spread across different asset classes. An important component of risk management, I believe, is maintaining transparency, flexibility and control over your investments. And that's becoming more and more critical for more people these days, particularly after what we saw happen 5 or 6 years ago with the global financial crisis. And a lot of people woke up one day and they realised they were 50% poorer. And a lot of people didn't know what to do or who to speak to about it. Since then, there's been a real push for more control over your own investments and more transparency in those investments as well. And that's one of the reasons why we espouse investing directly, which basically means that you own the shares directly rather than via a managed fund or some other unit trust structure. Owning the shares directly gives you a lot more control over those investments. You've got a lot more transparency over what you're invested in. They're all really important. In terms of the asset allocation process, it's important to have both a strategic and a tactical overlay. Strategic in the sense that you're taking a longer term view, you've got the right balance between defensive and growth assets. Tactical in the sense that it's a dynamic environment. World share markets go up and down. Things change in various sectors. The mining stocks, which might have been the flavour 4 or 5 years ago, aren't so much today. Banking stocks, which were bolted in 2008, 2009, for the last few years, they've been very much back in flavour. So it's a case of being tactical in moving between various asset classes, as we call them, when the timing's right or when it's appropriate. I think we use the word diversification there as well. It's a funny word. Diversification can mean a lot of different things to a lot of different people. For some people, it might mean having 800 different investments. It becomes a little bit unwieldy if you've got 800 different investments. I think diversification is more relevant when you're talking about diversification across geographic regions, different industry sectors, different growth exposures, different risk exposures, and also different income levels. So that's what I would call diversification, but it's also critical with diversification that, as I said before, you don't want too many assets because then it becomes too unwieldy. You want to still maintain some control over those investments. Risk management, assessment. In many ways, this is the most critical part of the process of determining where, not just a not-for-profit, but anybody invests their money. There's lots of different tiers to risk. There's lots of different type of risk. As I said before, there's geographic risk, there's liquidity risk, there's many different types of risk that any individual investment or investor can be exposed to. What we're really talking about when we're looking at a risk management assessment is finding a risk exposure that's going to be right for your particular needs. A risk exposure that meets your income requirements, that meets your liquidity requirements. If you're needing certain lump sums each year or at various points throughout the year, it's important that we've got diversification and the right risk management structure to incorporate that. And also maturities as well. I mean, if you're locking up your money for 2 or 3 or 4 years, you're going to need that money in 6 months' time, then perhaps we're not managing the risks appropriately. So risk management is largely about just matching off your tolerance for risk and your liquidity requirements and your maturity needs and your investments with the needs of cash flows in your business. Risk profiles. Don't get too hung up on the words. I'm not sure how well you can see that. You've probably all got the presentation in your pack there, but this is mainly to indicate that there's six broad asset allocation or risk profiles that we would generally look at for a typical investor. When we're talking about individual investors, what we'd generally be looking at is someone who's younger would be on the more aggressive level, someone who's more towards retirement or older would be at the conservative end. But obviously, it's going to depend on the life cycle of an individual or what stage in life they're at in terms of their income requirements, work situations. When it comes to a not-for-profit, that philosophy still applies because there are different risk levels and different maturity profiles that any investment is going to be subject to. So it's important that we match the right risk levels with the levels that you're comfortable with. And that involves investing across, as I alluded before, different asset classes. We'll invest across things such as Australian shares, across international shares. We'll have a fixed income component, and cash is also critical as well. And that just gives the as I said, don't get hung up on the weightings, but that just gives you an idea of the different staggering of risk profiles and the different weightings we can put into each category, which largely comes down to the fact that you do need some exposure to growth assets, you do need some exposure to defensive assets. And again, it all fits in with the risk profile and the risk tolerance levels and the income requirements that your organisation requires. Okay, so what can we do for you? Well, it says there we've got 65 years experience. I think the old bloke in the middle there, Bernard, he accounts for 64 of those years of experience. That's not exactly true. Troy and I have been around for quite a while. Bernard and I have actually got long and strong stockbroking backgrounds. We both began in the stockbroking industry in the mid-1980s, so I've seen a few crashes in that time. And we've also had exposure to a lot of, I guess, different and difficult cycles, economic cycles as well as share market cycles. So that does give us a lot of experience in order to manage all investments across different asset classes. Okay, performance figures. There's probably not a lot of sense that you can draw from those figures because there's no real benchmark that we've applied there, but that slide is essentially to highlight to you the fact that it highlights the different trends that we're seeing in the world economy at the moment, and we're seeing that the Australian share market has been a reasonable performer over the past, what are we talking about, 8 or 9 months, or up till I think that was up till the 31st of March, yep. It's been a reasonable performer. International share markets have been much stronger performers, but here's a critical kicker too. The reason why that international performance is much higher is because the Australian dollar's fallen so much over the past 12 months. In fact, over the past 2 or 3 years. Does everyone remember when it was at $1.10 against the US dollar? It's down around 77 cents now, so your overseas trip costs you about 30% more. But it's also a tailwind for investments. If we're investing offshore, and not every investor has exposure to that, but if we're investing offshore with a view that the Australian dollar is going to fall, you're going to get some real support for your investments there. And likewise also with Australian investments, we at the moment have a focus on Australian investments that generate a lot of their revenue from offshore. Companies such as Amcor and Ansell, Westfield, even QBE, they generate the bulk of their revenues from offshore. So we have a preference for stocks that do have exposure to US dollars in particular. And in an environment where the Australian dollar is falling, it just makes sense to be focusing on those sorts of businesses. Our performance, this isn't to beat our chest. This is simply to highlight various things. One is the benefit that you can derive from that direct investment exposure I mentioned to you before, investing directly into shares. And also in the process that we call active asset management as opposed to passive asset management. Investing directly in shares and taking an active approach, it puts us in a better position to outperform the various benchmarks. And as you can see, we're a little bit ahead of various industry benchmarks across the first 9 months of the financial year. And that's pretty typical for us over time, largely because of the fact that it's that direct investment approach, and also it's an active approach as well. We invest most money through what we call managed accounts. Now, has everyone heard of a managed fund? You might have all heard of managed funds. You've probably all got some in your superannuation. In managed funds, you don't actually own the asset. You don't own the underlying assets. You own a unit in a managed fund. With managed accounts, which are, the name's subtly different, but the difference between the two is quite profound. Managed accounts is where an investor owns those assets directly. So you would own shares in BHP, in ANZ, in Apple, in eBay, in Facebook, whatever the companies we're investing in. So you own those directly. There's various other benefits that flow from that, not the least of which is the transparency that comes with that, because you get to see everything that you're exposed to, all the risks you're exposed to. You see all the transactions, you see the turnover. So there's far more transparency through a managed account structure. There's nowhere to hide fees, compared to a managed fund where it can be quite opaque and you don't necessarily see what happens in the managed fund or where the fees necessarily are residing. The managed account approach is becoming far more popular because of the reasons I mentioned before. People want more transparency, they want more flexibility, and they want more control over their investments as well. That's where managed accounts come in. A global reach. We have the ability to trade on any stock exchange around the world in any country, any stock. We've got significant exposures to companies such as Apple, to Yum Brands, which owns KFC, Pizza Hut, Taco Bell, to eBay, Microsoft, Google. So all these companies that are really the up-and-coming behemoths of the investment world, we can have exposure to those. And we certainly benefited significantly from those over the past 36 months, especially as the Australian dollar has been falling over that period. We also conduct what we call a discretionary approach. It's not the only approach. We can maintain a consultative approach, if you like, but the most popular approach that people seem to opt for is a discretionary one, where we can just transact on your behalf without consulting first. And the appeal there is that we can act quite quickly for you, and we can also act for every investor at the same time, which is quite important. The consultative approach is something that might suit a lot of people, especially in the earlier stages of an investment relationship where you want to get a feel for how the money's managed and the process and rationale behind various decisions. But over time, people are generally more comfortable having the discretionary approach because of the speed with which you can act. Reporting is also critical, and that's something obviously we provide audited tax reports each year from our reporting service, Investment Structures. But it's also important that you know that you're able to ask for various meetings whenever you like. I mean, it's important that you have all the information you need and are given all the comfort that you require around those investments that you're responsible for. We will be very much at your mercy in terms of the period or the frequency of the meetings that you require to have a lot of comfort around that. Now, that's some reasonably broad strokes. We've talked a little bit about shares, we've talked a little bit about managed accounts, and we've talked a little bit about the discretionary structure that we operate. Does anyone have any questions that they would like to fire at Troy or myself? I have one up the back.
Hi, yeah. Just wondering if you could speak to ethical investing and I guess what kind of advice you might have for not-for-profits that might look to invest in organisations that have a similar or like-minded approach to their.
Yep. Really good question. There's a number of ethical funds out there. The difficulty with ethical investments is, where do you draw the line? And it's often very subjective. It's often very relative. If you wanted to be quite extreme about it, you'd say, well, banks lend to tobacco companies, so we shouldn't be buying shares in banks. You could say BHP and Rio Tinto, they pollute the waters and the atmosphere, so we shouldn't be investing in BHP and Rio Tinto. Some people will, it's difficult to cater for all those requirements because we can just rule out to the point where you're only investing in cash. I will stay away from anything to do with gambling or tobacco. I don't think we've got any alcohol-related investments in the portfolio. Not that I necessarily have an aversion to alcohol, but it's difficult to know where to draw that line, and then we need to cater for a lot of different investors. We have one of the beautiful things about the control that we give you through this transparent structure is that we can exclude particular investments if you're not comfortable with those. So we do have an ethical lane. But in order to cater for more individual preferences, we can exclude various investments. We've got some people who don't want to invest in Yum Brands because it owns KFC. They don't like the way they treat the chickens or use chemicals, etc. We've had people that didn't want to invest in Nestle because of incidences with baby food. And we're quite happy to exclude those from the portfolio. So whilst we have I won't call it a thin filter, but we do have an ethical filter. And I'd like to think I've got a reasonably strong moral compass, but we also throw it open to investors to direct us as to where they would prefer or not prefer to have investments. That's all right. Yes, sir.
Do you have any products suitable for short-term investment?
Yep. Cash is great for short-term investment. It just doesn't pay very much. It's very difficult, particularly in the current environment. And I think we're moving into a more volatile phase in the world economy and world share markets. The only safe short-term investment is cash. Unfortunately, even if we invest in something like bank shares, you're still prone to the volatility in share markets. And Australian bank shares will be affected by what happens in Greece. So it depends whether you're talking, I mean, short term to some people might be 5 years. If you're 20 years old, 5 years might be short term, but if you're 90 years old, 5 years feel like forever. So I can discuss with you later about any specific timeframes or risk structures that we can adapt for a particular timeframe, if you like. Was there any timeframe you had in mind?
I'm thinking really short term, 3 to 6 months.
3 to 6 months? Because really short term for some people might be 3 to 6 hours. So 3 to 6 months. Again, I mean, that's why term deposits always have, Troy did say before that cash rates are quite low, but in all my portfolios, I do have relatively high cash weightings because I think cash is an important tool. Whilst it's not providing very high rates of return, it is the ultimate defensive asset because it won't go down in value, except in a high inflationary environment. And also it provides a war chest for opportunities when they do emerge. So cash does have an important part in any investment portfolio, and it is one investment that won't go down. It then comes back to what sort of return you're looking for. Now, if you said to me, I'm looking at 3 to 6 months, I only want to make 2.5% over that period, I say, I can certainly look after you there. If you say I want to make 20% over that period, then we're probably going to be taking on a lot more risk. So again, the short term is a very subjective thing. The level of return or the level of income is also something that's going to dictate what we would look at, and also your risk tolerance. If you want to take a 3 to 6 month view, then I say I think we can get 20% return there, but we could also get a 30% loss. How do you feel about that? And if you don't like that idea, then maybe we need to lower the expectations of the return that we're going to get. So there's many answers to that question, and most of them come down to the fact that it depends on what sort of return you're looking for and what risk you're happy to take on.
Chris, what the real problem is for the non-profit sector or organisations that, as an executive member, term deposit obviously is the safest way to go.
Yep.
Once you start, because you're responsible for your members' finances, what boundary and responsibility do that or your organisation have, or your executive, once you start dabbling into shares?
Again, comes back to the profile of the funds that you're managing, and if they're being managed on a multi-year or even a multi-decade view, then there's generally going to be some expectation that they will need to grow over that period. If they're being managed with a view, and I can't speak for the mandate of your particular not-for-profit, but if they're being managed for the shorter term for income requirements, you can often have a little bit of a dilemma there, particularly if you're not getting the cash required from term deposits. So I think it's a very individual thing. But you're right, term deposits and cash are the ultimate low-risk investment.
As opposed to your own personal, when you look at your own personal finances, it's much easier to take a decision of what you want to do personally.
Yeah.
Because you have a responsibility, especially if you're a small organisation or limited.
Yes, no, I understand completely. Again, it comes down to what your charter will say, and then we can absolutely work with that to meet the objectives, and that's where it comes back to that risk assessment that I talked about initially, and that's quite critical because within your charter, if your risk assessment guides us towards an environment where you cannot take much risk and you cannot put the capital of your fund at stake, then that's ultimately going to lower the return we're going to get because I hate using the cliche, but the greater returns are generally going to come from the greater risk that you take on. So again, it's about matching your income requirements with your risk tolerance. I'm not sure whether that addressed the question fully, but it's quite open-ended, unfortunately.
What would be the minimum principle that would be worthwhile coming to a service like yours for? As in, what's the smallest sort of amount that it would be worth actually engaging you for?
Oh, look, we're happy to talk at any level, really. I mean, what would be the minimum you could think of?
I don't know. I mean, let's say 75,000.
Yeah, absolutely. Because that 75,000 is going to feed into something else. I mean, we could certainly be talking about an amount such as that. Yep.
Do you do any value investing for clients with, multi-decade time frames?
Yeah. I like to think that all the investing we do is value investing. An example of that would be, value investing is often seen as the lower risk investments. Unfortunately, over the last several years, value investment's the one that hasn't gone as well. It's been the growth investment, and that's because we've been in an environment where global asset markets, property and share markets, have been turbocharged by low interest rates around the world, and also some aggressive stimulus policies by central banks around the world. So all the growth assets have been well and truly outperforming value investing. That said, a company such as Woolworths, which most people would see as a real value investment, I think even value investments, if they're falling in value and they become greater value, then that's something I'd be absolutely looking at. And I bought Woolworths for all portfolios just recently, because for the first time in 10 years, they actually look like a real value investment because they'd fallen 25%. So all of the investment methodologies and rationale that we employ will have a focus on value. Bernard, the other gentleman you saw up there before, I guess he's more inclined to be growth focused, where I am more value oriented, because I always structure an investment portfolio day one with the view that I never want to sell anything, because I'd like to think that I buy everything day one, never sell it, because that means I've got it right the first time. And we can sit on it for the next 50 years. Real world doesn't work that way. I mean, every company goes through cycles, so that means that we need to be proactive in our management, but overarching that is a desire to make all investments value investments.
Is it easy to find companies that the market is undervaluing?
Very hard at the moment. Very hard. It comes back to what I said before about low interest rates and just a lot of stimulus from central banks around the world and governments around the world. Makes it hard, makes it very hard, and that's why I'm sitting on high cash levels at the moment, because I find it really hard to find value investments. But as I said, Woolworths falling 25%, I'm happy to pick that up. Commonwealth Bank falls 15%, I'm happy to pick that up, which is what I did a week ago. So having that cash nest egg, or the war chest there, enables us to pick up those value opportunities. And that's the problem. The only value opportunities that are emerging at the moment are when something's gone wrong in a business, such as with Woolworths, and that's when the value emerges. And that's when we take the view that the problems at Woolworths at the moment, they've identified them and they can fix them. They won't be fixed overnight. They'll probably take 3 years at the earliest to fix. But I take the view that 3-year view is going to see the share price a lot higher than where it is at the moment. I guess that's all. Thanks, everyone.
Chris, I know you don't have a crystal ball, but I'll ask a different question in terms of cash rates. Term deposits, when do you think we'll see 5% rates again? How long before we see 5% term deposits and higher?
At least 3 years, possibly 4. Possibly more. What are we, 2015 now? I think it could be 3 to 5 years. 3 years at the very earliest, and I think that's unlikely. It's going to be a long time. We're battling against a global demographic wave at the moment. That's one of the many things that we're battling, but one of the fallouts from 2008, 2009, I mean, the financial crisis was generated by a lot of debt. And now we've tried to, when I say we, I mean the world, has tried to address that problem by taking on more debt. There's about twice as much debt in the world today as what there was 7 or 8 years ago, which is quite extraordinary and it's quite scary. And that debt's got to be paid off. In a world where it's ageing, America, Australia, even China, we're talking about an ageing world. And the bulging part of demographics over the next 5 to 10 years is going to be the people over the age of 50 and 60. So we're going to have more people relying on social security and governments to support their welfare, and fewer people at the younger end who are working and paying taxes to pay for that. So that's going to be one of the big issues that I think are going to keep interest rates low for, I say, 3 to 5 years. It could be even longer. So it's going to be tough.
Okay. Thanks very much, Chris.
Thanks, Paul.
Thank you.